Hi folks, this is Rajat Bose here again. I've come to present the 14th edition of Market Outlook comprising Nifty, Bank Nifty and cnxmidcap. The last week had been a tumultuous week, lot of market movements. Whether we are going to see some kind of a sustained correction or it's a short-term one, we would see that. Apart from that, we are going to review quite a few stocks. If there were to be any kind of change in the texture of the market, how do these stocks behave? These are reviews, not recommendations. Of course, there will be recommendations. Recommendations, at least for two stocks, would be there. Even in such markets, there could be some good buying opportunities. Keep watching my channel. Talking about the Nifty, what I would like to say is that there had been, not just in Nifty, but in other indices as well, there is a significant thing that has happened. That has not happened for the last 3 months. Never before. Over the last 3 months, on the daily chart, the 9-day exponential moving average came down from above, piercing the 20-day moving average. At least on Wednesday, they were showing such signs. This is the first major chinks in the armor of the bulls. We are going to review it thoroughly for you. First, let us look at the weekly chart. Weekly chart shows that the Nifty index has been showing weakness for the last couple of weeks. It is somewhat on the back foot, and it is almost tasting 9-week exponential moving average. This 9-week exponential moving average is currently located at 19,244 and the index closed at 19,517. The point is this, that once you look at the daily chart, especially something that has happened over the last week, it needs to take out 19,500 to about 19,600 in a decisive manner, and so long as it doesn't do that, it's the threat of further lower levels continues to remain. And if it were to fall below the 19,300 mark, then it could again be heading or testing, say, 19,100, 19,000 support area. Once those levels are taken out, next stop could be 18,800 or 18,580 is a strong support area. Around that level, if it were to go, that would be a considerable down move. Let's see how things pan out. But now, since the close has not been above, say, 19,650 or 19,700, in fact it is way below that. It is not even 19,550 on the weekly basis. It shows that bears will start the coming week with an advantage. When you see the daily chart, you will see one thing, that even in the CNX Nifty, it has actually shown that bearish crossover, that 20-day exponential moving average has been pierced by the 9-day exponential moving average. It has happened on Thursday, and despite a white candle or despite a green candle, which is a bullish candle on Friday, the bearish crossover still remains, and till such time, according to the 9-day exponential moving average and the 20-day exponential moving average, both are located at within a range of 45 or 40 points. 19,591 is the 9-day exponential moving average and 19,626 is the 20-day moving average. This range of 35 points needs to be taken out by the bulls with a lot of firepower, lots of buying, lots of volume should come in. Only then we can expect a sustainable recovery. Otherwise, there is every possibility, since the in last, say, 4 months or so, what we have not seen. This time we have come very close to that. The lower Bollinger Band was almost tested this last week. On Thursday, the low was 19,296, and the Bollinger Band low 19,261. So only 35 points were to be covered, otherwise it would have tested the lower Bollinger Band. And the 50-day moving average was at 19,160. So if there were to be a fall below 19,160, then a case can be made for a probable termination of the erstwhile very strong intermediate uptrend. But so long as 19,160, or better still, let's assume that unless the 19,000 mark is not decisively broken, the bulls still stand a chance to stage a recovery. In fact, only after 19,000 is decisively broken, we would say that the bears are in control, and probably the 4-month-old intermediate uptrend has been terminated. Otherwise, it would still be a course correction. Discuss the 125-minute chart. Here what you see is that the 20-unit moving average and the 50-unit moving average are about to give a death cross. Death cross happens when two moving averages which are downsloping, and the shorter term moving average is about to pierce the longer term moving average. So if that happens, that would be even more bearish than what it is now. But we must see one thing, that as we were discussing a little earlier, that unless 19,000 is broken, there is still hope. So here again we see the same thing. 19,000 needs to be broken decisively. Only then the intermediate uptrend will be in real danger. The foregoing week, Wednesday, was a very important day for the simple reason that an event that happened for the first time in last 3 or 4 months, that is, Bank Nifty was coming down from above and piercing its 9-day and 20-day exponential moving averages. Not just that, the Bank Nifty 9-day exponential moving average was piercing below the 20-day exponential moving average. This is a bearish sign. At least there could be some sustained fall. Let's see how things are unfolding. We would study it in detail. We start with the daily chart. The daily chart clearly shows that the Bank Nifty, for the first time since early April, it is testing the 50-day moving average from above. That means it has already broken 9-day moving average, 20-day exponential moving average, and now 50-day exponential moving average, which was broken on Thursday. On Friday, it bounced back again above the 50-day moving average, but the situation is not that great. There is a possibility, real possibility, that Bank Nifty might actually show more weakness. What we see here is that unless we find that the range between 45,228 to 45,356, this is the range between the 9-day exponential moving average and the 20-day exponential moving average. So long as 45,350 is not crossed, the Bank Nifty would continue to be in danger of falling further. And if it were to break that 44,650 again, that is the 50-day moving average level, then there would be further fall. And already the trading is happening for the last 3 sessions, that is Wednesday through Friday last week. It was within the 9-day moving average and on the upside, whereas support was being given by the 50-day moving average, and the Bollinger Band is going down. So there is every possibility that it would be pretty much a difficult proposition for the bank bulls to negotiate with the selling pressure. Of course, once they take out the 45 350 and levels higher than that, then they would recoup their strength. When you look at the weekly chart of the Bank Nifty, you will see very clearly one simple thing, that the 9-week moving average has been tested. It was pierced. Finally, it closed just a tad above that. 44,737 is the 9-week exponential moving average, and 44,879 is the close. So chinks in the armor are clearly visible in Bank Nifty, even on the weekly chart. And this weekly chart shows that two successive red candles, and now there is a clear possibility that the 44,737, the 9-week moving average level, could well be tested again, and it could go further down. Now the real weakness will happen 1,000 point lower, that is about 43,450 kind of range, 450, where the 20-week moving average is located. If that gets taken out, then we have to say that there is a serious threat to the uptrend that Bank Nifty was exhibiting. Bank Nifty could be in danger. Bank Nifty is the weakest of the three indices, Nifty, Bank Nifty and cnxmidcap. Let's see how things happen. See, on the 125-minute chart, what we see is that the Bank Nifty actually has seen a bearish crossover of 20 unit and 50 unit moving average, and on the 200 unit moving average it took support. So this 20 and 50 bearish crossover in the 125-minute chart doesn't augur well for the Bank Nifty. Possibility has it that the 200 unit moving average, which is located around 44,300 kind of levels, that could be taken out. That could be taken out by 44,325 is the 200-day exponential moving average level for the Bank Nifty. Unless 44,300 gets broken, there is no major threat. At the same time, till such time 45,240, 45,250, that kind of levels are not taken out on the upside decisively, Bank Nifty would continue to show a range bound movement, but mostly the weakness is likely to get more accentuated, more pronounced, because of the bearish crossovers that we have discussed. The CNX midcap generally performs the best. It didn't even test the 9-day exponential moving average throughout this long bull run from early April. But on Wednesday, even this CNX midcap also pierced its 9-day exponential moving average, and it was sliding down towards its 20-day moving average. So is it the onset of a major correction? Yes, we would study the midcap index as well, and not just that, we are coming up with a lot of stocks which would be reviewing to see and understand whether the stocks are going down from here. CNX midcap 100. We are here first looking at the daily chart of CNX midcap. Here we are using a Gann angle, a set of angles based on WD Gann's ratios, and the Bollinger Band and the 9-day exponential moving average and the 20-day exponential moving average. What we see very clearly on the chart, that is in the middle of this several angles that are there, the upper Bollinger Band and the 9-day exponential moving average still continues to encapsulate the price activity of CNX midcap, and the Gann angle also, just as the 20-day moving average is there, the Gann angle is also between the 20-day moving average and the 9-day moving average. So that is also giving support. So unless this middle Gann angle, that is the fourth, counting from the left, the fourth angle is actually where the it is CNX midcap is climbing higher with the fourth angle as its support, and also the 9-day exponential moving average is giving it support. It did show some weakness in midweek, at least on Tuesday and Wednesday. It fell below the 9-day exponential moving average, but next 2 days saw some kind of a recovery. So CNX midcap, we would have to say that it is, at least on the daily chart, the signs are very clear that it is not showing any major weakness. On the contrary, it is actually a sign of the continuation of the uptrend. Now we go to the weekly chart of CNX midcap. What you see there is that the weekly chart is even stronger. It is going up and up, and the weekly chart shows that all green candles for the last 6 weeks we have seen green candles, and in between there was red candle, and again on the lower portion you will see only green candles. That means that CNX midcap has been moving up very strongly. There is enough support, and 9-week moving average has not been tasted throughout this bull run. So CNX midcap continues to show considerable strength. So far there is no major threat, except for 1 or 2 days of heavy selling. Sometimes there is no major threat we have seen. So CNX midcap upswing continues. If you like my presentation, please press the like button, subscribe to my channel, press the bell button, and also share it with others. We have already covered the indices. Now we are going to cover stocks. First, we would actually review a number of stocks. It is this time we are doing it because to understand whether this uptrend, this intermediate uptrend that have lasted for almost 4 months or so, whether that uptrend is coming to a conclusion or coming to an end, and either a sideways movement or a downswing. What is going to happen? That's the reason why some large caps, some mid caps, even some small caps we would review in this week's edition, the 14th edition. CNX FMCG index over the last couple of weeks has been showing considerable weakness. First, 2 weeks prior, in fact, the week starting 17th of July, that week we saw an inverse spinning top, and after that the next 2 weeks, concluding with the week ending on 4th of August, we saw two red candles, 2 bearish candles, and even on the weekly basis it has actually tested the 9-week exponential moving average, which is at the end of 4th of August, it was at 52,110. So what it shows is that the FMCG stocks, be it Hindustan Lever, be it ITC, be it other stocks, FMCG index is not performing as strong as, say, the CNX Pharma index. CNX Pharma is going great guns, but CNX FMCG is actually either it is taking a breather or there is a probable trend reversal awaiting. So on the chart, what you see here is that CNX FMCG index has decisively come below the 9-day moving average. In fact, just as in a downtrend what happens, that is what is happening on the chart. That is, a 9-day exponential moving average is resisting the CNX FMCG in intraday trading, and it is taking support on the lower Bollinger Band. This is a classic case of uptrend morphing into a downtrend. So we should be a bit wary of FMCG stocks and should be very watchful about them because they could show further weakness. CNX Auto Index is showing a bit of loss of strength in the sense that it has actually broken the 9-day moving average as well as the 20-day moving average, and there has been 3 days back, that is last Wednesday, when the CNX Auto Index fell and tested the 20-unit Bollinger Band, 20-day Bollinger Band. This happened on 2nd of August, and the CNX Auto Index closed at 15,428. That time it actually gave the bearish crossover between the 9 and the 20-day moving averages. For the next two sessions on Thursday and Friday, the CNX Auto Index could not sustain above, sustain at higher levels. On Friday, it opened higher. In fact, the day's high almost within 50, a little over 50 points from the opening. 15,469 was the open and 15,513.55 is the high on that day. But finally, it closed much lower. It closed at 15,328. So what is the import of the whole thing is that auto index looks weak, and on the weekly chart of the CNX Pharma Index, what we find is that there had been an inverse spinning top. Then there is a red candle in last week, that is the week concluding 4th of August. So there is a possibility that the auto stocks might actually suffer, and CNX Auto might well test the 9-week exponential moving average, which is located at 15,105. So suffice it to say here is that the auto stocks would be under some kind of pressure. CNX IT, unlike the other sectoral indices, it is showing, as you can see on the 1-year chart, it is showing quite a bit of volatility. It goes down, then goes up, then again down, up. This is the thing, that on the upside about 31,500, and on the downside about 26,500. So within this 5,000 point range, CNX IT has been moving for the last 1 year. CNX IT at the moment, although on Friday it actually showed good bit of strength, it showed good bit of strength on Friday. It closed 465 points higher, but it is far lower from the range high. Range high is around 31,500 or slightly above that, whereas now it is at say 30,436. Is cool. 1,000 point needs to be covered on the upside, but 31,500 to about 31,650, this is the supply zone for the CNX IT index. Unless this range is decisively taken out by the CNX IT stocks are not going to show strong bull run. Some of them would be doing pretty well and some may not do so well. So sometimes you will see Coforge or say maybe some other stocks moving up, and sometimes you will find that they are underperforming. The leaders like TCS, Infosys, HCL Tech, they are not doing anything great. So this is a range bound activity there. It is likely to continue. Expect selling in CNX IT if it goes close to 31,500, and on the downside, unless it falls below 29,000 mark, CNX IT would not be bearish. We're going to start the brief review on CNX Pharma Index. CNX Pharma Index has closed at 15,241. This week it has posted a new high of 15,302 and finally closed at 15,241. CNX Pharma has been moving just like the CNX midcap index. It was right since 17th of May, or it has actually started moving up, and once it crossed the 20-day and the 9-day moving averages, then it was encapsulated by the 9-day moving average and the upper Bollinger Band. And so far there is no sign of any kind of weakness in the CNX Pharma Index. And CNX Pharma Index, the 9-day exponential moving average is at 14,888. Unless at least this is taken out on the downside, there would not be any threat of the CNX Pharma Index. So pharma stocks, just like you have seen that Cipla, Divi's, Dr. Reddy's, lots of other stocks have been moving up in a strong manner. The strength is likely to continue. That's what we conclude. So CNX Pharma remains bullish. Our first review stock is Bajaj Finance. Bajaj Finance, all the targets that we have given when we recommended it in early May, the targets had been 7,000, and then thereafter it was 7,480. It crossed 7,480, it went up, and it finally touched a high of 7,999.90. It was, I think, early July when this close to 8,000 level was reached. After that, Bajaj Finance has started coming down. But it has recently, over the last couple of trading sessions, it has even breached its 50-day moving average. Looks a little weak, but I would suggest you continue to keep a stop loss around, say, 7,025 or so, or just below 7,000, it could be your stop loss, and continue to hold it. Unless it takes out 7,425, if in a rally, if you find that Bajaj Finance is not taking out 7,425, that is a very critical level. In that case, get out of this position. Otherwise, if it were to fall below 7,000, you on closing price basis, you get out of the position. 6,995 should be your stop loss. If 6,995 is hit on the close, exit this position. Now our second review stock is Axis Bank. Axis Bank was given on the very second edition of our stock recommendation and market outlook. Axis Bank has met its earlier targets of 909 and 969. Currently it has closed on last Friday at 952. The movement is somewhat on the downside, especially the last three trading sessions had been somewhat weak. It was below the range, below the 50-day moving average. 50-day moving average was at 950, so the close is just above that. But Axis Bank, unless it falls further and it closes below, say, 925, which we would recommend as our fresh stop loss level, that on closing price basis it should be below 925, then you exit the position. Otherwise, there is every possibility that it can bounce back to retest 980 or even higher levels. On the upside, two targets are 1,030 and 1,064. Unless you see Axis Bank falls below 925 and closes below that, do not exit the position, carry on. You might get 1,030 to 1,064 once the bank stocks start coming back into the bullish mode. Axis Bank is not yet that weak. Keep that in mind. If you like my presentation, please press the like button, subscribe to my channel, press the bell button, and also share it with others. We would come up with two recommendations. Yes, the recommendations are buy calls, even in this market. Mahindra & Mahindra, an auto stock that we are recommending despite the fact that CNX Auto Index is not doing anything great. It is not showing as much strength as the CNX Pharma Index, but still we suggest that you buy M&M, buy for the medium term, put a stop loss below 1367, targets would be 1800 and 2075. So medium term, when we say medium term, we mean that you are actually looking at say 9 months to about a year or so. That is the time duration for the stock. Once you look at the daily chart, you find that Mahindra and Mahindra over the last few days had been showing some weakness. Despite its showing weakness, it after testing 50-day moving average, it bounced back. It is still not above the 9-day moving average, and there could be a seesaw movement, but overall pattern of the Mahindra and Mahindra chart suggests that it is headed further up, and this correction that is happening in the market, it is not terminating the bullishness right away, and the select auto stocks will continue to do well. Mahindra, we believe that it is headed for higher levels. Now, if you look at the weekly chart, Mahindra is showing for the last 3-4 weeks it is coming down from the levels close to about 50 plus levels. It has come down. Currently it is at 1464, but this is a course correction because Mahindra and Mahindra started its journey from just above 1100 marks to about close to 1600 levels. So 500 point run is now getting corrected. 9-week moving average has been tested, but the last week had been a hammer line that gives us a confidence that there could be a bounce back in this stock. Overall, from a longer term point of view, Mahindra and Mahindra continues to be a bullish stock, and we suggest buying into this. So you keep a stop loss at 1367 on closing price basis, and for over a period of 9 months to 1 year, expect 1800 to about 2075, assuming that bull run in the market continues. UBL is one of our recommended stock this week. UBL, continuously bullish about UBL, and UBL, it is a repeat recommendation. It's not just a review, it's a repeat buy call. This time we are actually looking at UBL to be going further up. Our targets are 1704 and 1790. These are the medium term targets, and immediate short to medium term target is 1630. So 3 targets, 1630, which is 50 points away from the current close, and then thereafter 1704 and 1790, and we put a stop loss below 1449 on closing price basis. That is a 130 point kind of stop loss, and on the upside we are looking at 200 points, but in our view, if 1790 gets crossed, then this stock could be headed for 1850 to 1900 kind of levels. So UBL is a repeat recommendation, and we suggest that you hold it for about a year or so. So UBL is a buy call. It's a repeat buy call from our end. Thank you for being with me. Thank you for watching my program. Thank you for watching this channel.